Have you ever heard someone say, the market is up, or the market crashed, and had absolutely no idea what they meant? Don't worry. By the end of this video, it will all make sense. Welcome back. Today, we're breaking down two of the most important terms in investing, the bull market and the bear market. These two phrases describe the direction the stock market is moving, and understanding them is the very first step to thinking like an investor. So let's start from the beginning. The stock market is simply a place where people buy and sell ownership in companies. Think of it like a giant marketplace. But instead of buying fruit or clothes, people are buying tiny pieces of real businesses. When a company wants to grow, it needs money. Instead of borrowing from a bank, it can divide itself into thousands of small pieces called stocks or shares. It then sells those shares to the public. Anyone who buys a share owns a small part of that company. If the company does well and grows, the value of your share goes up. You can then sell it for more than you paid. That's how people make money in the stock market. Buy low, sell high. Let me make this even simpler. Imagine your friend opens a pizza shop. The shop costs $1,000 to start. Your friend splits it into 100 equal pieces, each piece worth $1. You buy 10 pieces. You now own 10% of the pizza shop. A year later, the shop is doing amazing. People love the pizza. The whole shop is now worth $2,000. Your 10 pieces? They're now worth $200. You doubled your money. That's the stock market in a nutshell.
Now, here's where the bull and the bear come in. A bull market is when stock prices are rising and rising consistently over time. The economy is doing well, people are confident, companies are growing, more and more people are buying shares, which pushes prices up even further. Why a bull? Think of how a bull attacks. It thrusts its horns upward. That's the image. Prices going up. A bull market is generally a good time for investors. If you already own shares, their value is increasing. People feel optimistic and money is moving. A bear market is the opposite. Stock prices are falling, typically by 20% or more from their recent high, and the decline lasts for a while. The economy might be slowing down. Companies might be earning less. People start selling their shares out of fear, which pushes prices down even further. Why a bear? A bear attacks by swiping its claws downward, prices going down. Bear markets can be scary, especially for new investors. Seeing the value of your investment drop is never fun. But here's the important part. Bear markets are a normal part of the economic cycle. They don't last forever. Now, a quick reality check. Stock prices go up and down. No one can predict the market perfectly. Not experts, not apps, not anyone. Investing always carries risk. The value of a share can fall just as easily as it rises. This is why smart investors think long-term, stay patient, and never invest money they can't afford to lose. The stock market is not a get-rich-quick machine. It's a tool, and like any tool, you need to learn how to use it wisely. So to bring it all together, a bull market means prices are rising and confidence is high. A bear market means prices are falling and caution is in the air. Both are natural parts of how markets work.
The key takeaway? Understanding the market starts with understanding its direction. And now, you do. If this helped you, hit that like button and subscribe for more beginner-friendly finance videos. See you in the next one.